Bond yields are rising fast, but what do they really say about inflation? Understanding this could protect your savings and investments right now. Bond yields are essentially the interest rates on government or corporate bonds. When yields go up, it means investors want more return for lending their money, often because they expect inflation to rise or the economy to heat up. Conversely, falling yields can signal expectations of slowing inflation or economic downturns. For example, U.S. Treasury yields have been climbing steadily this year, indicating growing inflation worries among investors. When inflation is expected to rise, bond investors require higher yields to compensate for the reduced purchasing power of future interest payments. This relationship means that analyzing movements in bond yields gives a window into market-based inflation expectations. For instance, Treasury Inflation-Protected Securities, TIPS, yields help economists gauge the market's inflation outlook. The gap between nominal Treasury yields and TIPS yields, known as the break-even inflation rate, has recently widened, highlighting rising inflation expectations. Looking at real market data, 10-year U.S. Treasury yields rose by nearly 0.7 percentage points in the first quarter of 2026 alone. This jump reflects investors demanding higher compensation against anticipated inflation pressures. Companies like BlackRock and Vanguard have noted this trend, emphasizing that bond market signals suggest inflation won't cool off quickly. This contrasts with some Federal Reserve projections, showing a disconnect between market and policy expectations. Higher bond yields don't just influence Wall Street. They directly affect borrowing costs for millions of Americans. Mortgage rates, car loans, and business credit often rise in tandem with Treasury yields. This means your monthly payments could increase, and companies may face higher funding costs that trickle down into consumer prices. Investors holding long-term bonds may see their portfolios lose value as yields climb, making it crucial to understand these signals now. The sustained rise in bond yields indicates that inflation expectations remain elevated in 2026. This puts pressure on the Federal Reserve to potentially keep interest rates higher for longer to tame inflation. Market watchers at Goldman Sachs and JPMorgan warned that ignoring these signals could lead to surprise market volatility. Staying informed about bond yields gives you an early warning on inflation trends and economic shifts. Given these insights, you should keep a close eye on bond yield movements and inflation indicators. Consider protecting your investments by diversifying or seeking inflation-hedged assets. If you plan to borrow or refinance, watch for rising interest rates tied to bond markets. Understanding bond yields isn't just for economists. It can help you safeguard your financial future in a volatile inflation environment. Bond yields are more than numbers. They are a real-time radar for inflation and economic shifts that impact your wallet. By understanding what these yields reveal today, you can make smarter financial choices and stay ahead of rising costs. Stay tuned for more updates, and don't forget to subscribe for the latest insights that affect your money and future.